We're going to focus on two countries. We're going to focus on the US and the eurozone. And if you look at the interest rate prevailing in those countries, especially the long-dated ones, they've fallen dramatically from a peak in March, April to where they are now. Normally, when interest rates fall that much, it's a sign that financial markets are predicting either dramatic slowdown in growth or even a recession. Now, there's reasons to think that the economic signal that is sent by the yield curve are exaggerated. One of these reasons is that the level of interest rates is, like any market, determined by supply and demand. At the moment, central banks are hovering up to the tune of 120 billion per month at the Fed and to the tune of 100 billion euros per month at the ECB of bonds from the market. So that is tipping the scale in favor of demand, and this is making interest rate collapse basically. But what's changed is that in the summer months, in particular in July, market liquidity is much lower than it is in normal circumstances. So the impact of those purchases have been a lot stronger. So I'm not discounting 100% these economic worries or apparent economic worries, but by and large, the reason why interest rates have dropped so much, it's basically because of central bank interventions. So as much as I think that interest rate could drop further by the end of this year and by next year, when some of these central bank purchases will be phased out, in particular the Fed, then interest rate will reflect more accurately economic fundamentals, and that means higher interest rates, in particular in dollars.